There's a question that has sold more life insurance than every statistic the industry has ever published. You've probably heard it, maybe at a kitchen table, maybe in an office with a folder open between you and someone with a laminated rate card. The question goes something like this: if something happened to you tomorrow, what would happen to them? Notice what just happened. Nobody quoted you a probability. Nobody showed you a mortality table. You were handed a feeling, and then you were handed a price for making that feeling stop. Here's the part almost no one examines. That price was calculated long before you felt anything. Your fear had a number attached to it before you walked into the room. In the next 20 minutes, I'm going to show you that number, where it comes from, and who collects the difference. Life insurance occupies a strange and protected place in personal finance. It's the one product you buy purely for someone else, not for returns, not for convenience, not for yourself at all. That's exactly why questioning it feels wrong. Buying a policy is treated as a rite of passage, one of the quiet signals that you've become a serious adult. New baby, new mortgage, new policy. The sequence is so culturally embedded that skipping the third step feels like negligence, and the belief underneath it is coherent. It goes like this: my family depends on my income. If I die, that income disappears. A responsible person transfers that risk to an institution built to carry it. The math of protection is the math of love, and you don't negotiate love. So most people don't negotiate. They don't compare the way they'd compare a car loan or a phone plan. Surveys consistently show that people don't even know what the product costs before they buy it, and many never find out what it should have cost after. Comparing feels like haggling over your family's safety, and haggling over your family's safety feels like a character flaw. So the purchase happens quickly, often in a single meeting, often within weeks of a major life event. And afterward comes the feeling the product was actually built to deliver: relief. The box is checked. The people you love are covered. You did. Belief is not stupid. Income protection is a real problem, and pooled mortality risk is a genuinely useful invention, one of the oldest in finance. The belief only becomes a problem because of what's been quietly attached to it. Because somewhere between the actuarial table and the kitchen table, the product stopped being priced to your risk and started being priced to your fear. Here is the first crack, and it comes from the industry's own numbers. Roughly 2% of term life policies ever pay a death benefit. 2%. The other 98% end with the insured outliving the term or letting the policy lapse before it matters. Now, on its own, that number isn't damning. Term insurance is supposed to be a product most people never use, the same way a fire extinguisher is. You're paying for the tail risk, not the expected outcome. But hold that number next to a second one. A study published in the American Economic Review found that 29% of permanent life insurance policies lapse within the first 3 years. 57% lapse within 10. These are the policies sold as lifelong commitments, the ones marketed as the more responsible, more permanent form of protection. More than half of the people who buy them stop paying within a decade. And when a permanent policy lapses in its early years, the policyholder typically walks away with a fraction of what they put in, sometimes nothing. Think about what that pattern implies. If this were a product people bought after coolly assessing a risk, you would expect it to be held the way risks are held, steadily for as long as the risk exists. The risk of dying does not disappear in year 3, but something else does disappear in year 3: the feeling. The fear that was present at the moment of purchase, the new baby, the health scare, the agent's question hanging in the air, that fear fades on a predictable curve. And the lapse data traces that curve almost perfectly. People aren't abandoning a risk calculation. They're abandoning an emotional state they no longer occupy, one they signed a decades-long payment obligation inside of. Sit with that gap for a moment. We're going to measure it. The mechanism has a name: fear monetization. It's the systematic conversion of mortality anxiety into premium revenue, and it works by answering an emotional question with a financial product while charging financial product prices for emotional relief. It was not always this way. Early life insurance in the 1800s had a genuine problem. Nobody wanted it. Putting a cash value on a human life was considered morally repugnant, close to gambling on death. The sociologist Viviana Zelizer documented how the American industry solved this, not with better actuarial arguments, but by rebranding the product as a sacred duty. The pitch shifted from mathematics to morality. A man who died without insurance hadn't merely miscalculated. He had failed his widow and children. The industry didn't sell probability. It sold absolution from a guilt it had first helped construct. That template, built in the 19th century, is still the operating logic of the sales process today. And the modern version has been refined with a century of behavioral research the original salesman never had. The technique is called mortality-salience. When people are made to think concretely about their own death, their risk perception distorts in measurable ways. Rare, vivid outcomes feel imminent. Statistical thinking degrades. Willingness to pay for relief rises. Every version of the kitchen table question, what would happen to them, is a mortality salience trigger, deployed at the precise moment a price will be quoted. Now look at how the pricing actually works, because this is where the mechanism becomes visible in the numbers. Inside the insurance company, your risk is priced with cold precision. Actuarial tables estimate, to a fraction of a percent, the probability that a person of your age, sex, and health profile dies in a given year. That internal number is the true cost of your mortality risk, and for a healthy adult in their 30s or 40s, it is remarkably small. Outside the company, at the point of sale, a different number appears, the premium. The spread between those two numbers, between what your risk costs and what your fear will pay, is the revenue engine. And the industry's own research shows how wide that spread can run in the customer's mind. LIMRA's 2025 Insurance Barometer found that healthy adults under 30 asked to guess the cost of a basic $250,000 term policy overestimated the real price by 10 to 12 times. About 3/4 of all adults overestimate the cost. The industry publishes these findings as a marketing challenge, an education gap to be closed. Read them the other way. When a purchase is framed around fear, the buyer has no internal price anchor, because fear doesn't have a market rate. You cannot comparison shop a feeling. A person who believes protection costs 10 times what it does will not blink at a premium 3 times the actuarial cost. The distortion isn't a failure of the sales model. It's the headroom the sales model operates in. Then there's the question of which product gets sold into that headroom, and here the incentive structure does the talking. In 2024, American life insurers paid out $63 billion in commissions. On permanent policies, first-year commissions routinely run to a large share of the entire first year of premiums, at some carriers exceeding 100% of it, while renewal commissions in later years are a small fraction of that. And permanent policies carry premiums roughly 6 to 10 times higher than term coverage with the same death benefit. Follow the arithmetic from the agent's chair. Same client, same fear, same evening. One product pays a commission on a $30 monthly premium, the other on a $400 monthly premium, with most of the first year's payments flowing toward distribution. This is also why permanent policies typically build almost no cash value in the first year or two. The money isn't missing. It went to the people who sold the feeling. There's a second-order effect buried in this structure that economists have a name for: lapse-supported pricing. Because the company's models anticipate that a large share of buyers will abandon their policies after paying the expensive early years, some products can be priced with that abandonment already baked into the profit projections. The customers who leave subsidize the economics of the whole book, which means the fading of your fear isn't a risk to the business model. In a very real sense, it's a line item in it. The industry earns on the fear when it arrives, and it earns again when the fear departs and the policyholder walks away from money already paid. So assemble the machine. A 200-year-old moral framing makes the purchase non-negotiable. A mortality salience trigger is applied at a life moment when fear is at its peak. The buyer has no price anchor because fear has no market rate. The commission structure steers the sale toward the heaviest product, and the payment obligation is set to run for decades, long after the triggering fear has faded. Hold on to that spread, the gap between what you paid for and what your risk actually required. That gap is where the industry lives, and in a moment we're going to watch it open up inside one household, month by month. Consider Marcus Webb. He's an illustrative case, a composite built from the market figures we've already verified, not a real client file, but every number attached to him is a real market number. Marcus is 41 now, a project director earning $145,000 a year, married, 2 kids, 6 and 9. 3 years ago, when he was 38, his daughter spent a night in the emergency room. Febrile seizure, terrifying to watch, harmless in the end. She was home by morning. Marcus was not the same by morning. 11 days later, he was sitting across from an insurance agent his coworker had recommended. If you ask Marcus then, he would have told you he was making a rational decision, and by his own lights he was. The agent asked the question. Marcus pictured the ER waiting room. The meeting lasted 50 minutes. The agent never showed him a mortality table, never mentioned the word probability, never put a second product on the table for comparison. What the agent showed him was an illustration, a projection of the policy's value at age 65, printed in a clean chart with an upward slope. The recommendation was a whole life policy. $500,000 of coverage, permanent protection, builds value, protects the family forever. The premium, $412 a month. Term insurance came up once, near the end, framed the way it usually is in that chair. Renting your coverage instead of owning it. Nobody wants to rent when they can own. Marcus signed that week. That is $4,944 a year. The conventional wisdom he was handed, and repeated to his wife that night, was that this wasn't spending. It was building something. An asset with his family's name on it. Now run the clock forward 3 years to a Tuesday evening this past spring when Marcus actually read his annual statement instead of filing it. Total premiums paid over 36 months, $14,832 cash value, $4,690. He read the 2 numbers 3 times, assuming he was misreading a column. He wasn't. Nearly $10,000 of the difference had gone to commissions, fees, and the internal cost of the product's early years, exactly as the structure dictates. The upward sloping chart from the original meeting had been real. Technically, it just started its climb from a hole he was still standing in, 3 years after the money left his account. Then Marcus did the thing the original meeting was engineered to prevent. He looked up what the alternative would have cost. A 20-year term policy with the same $500,000 death benefit for a healthy man of 38 runs in the neighborhood of $30 a month in the current market. Call it 31. The identical protection for his family, priced at $372 a year instead of $4,944. The difference, $381 a month, comes to roughly $13,700 over the 3 years he'd been paying. Then he found the last number, the one that reframed all the others. The statistical probability that a healthy 38-year-old man dies before 48 is in the low single digits. His premium had never been priced against that probability. It had been priced against a night in the emergency room, against the version of him that existed for a few weeks in the fall of 2023. The insurer had actuarial tables. He had a memory of a hospital corridor. They were never doing the same math. Here is where the story refuses to resolve, because that's how this mechanism works. Marcus hasn't canceled. Canceling now means surrendering at a loss, converting a paper mistake into a realized one, and the product's early year structure makes every exit door expensive. He hasn't stopped paying either. He sits with something he doesn't have a clean name for, so we'll give it one. Responsible dread. The knowledge that his most responsible feeling financial decision was also his least examined one, and that the feeling of responsibility was precisely the thing that stopped him from examining it. Now scale Marcus up, because he is not an edge case. He is the unit economics of an industry. $63 billion in commissions paid in a single year, 2024, and commissions are only the distribution layer. Underneath it sits the lapse economy, Recall the figure: 57% of permanent policies gone within 10 years. Every one of those lapses is a Marcus who paid the front-loaded years, the expensive ones, the ones engineered to recover commissions and fees first, and then exited before the product's backloaded benefits arrived. Researchers who study this pattern describe lapsing not as a malfunction of the business model, but as a feature the pricing quietly depends on policies priced with the expectation that many buyers will pay in during the costly years and leave before collecting. The fear pays in, the fading of the fear pays out to the other side of the table. And here is the strangest part of the aggregate picture. For all this monetized fear, the country is not actually more protected. Self-reported life insurance ownership has fallen from 63% of American adults in 2011 to 51% in the most recent barometer study. Roughly 100 million American adults sit in what the industry calls the need gap, people who by conventional measures need coverage, or more of it, and don't have it. So, the fear-based model produces both failure modes at once. On one side, people like Marcus overbought into products whose cost bears no relationship to their risk. On the other, tens of millions so intimidated by a product they believe costs 10 times its real price that they buy nothing at all, and their families carry the raw risk uninsured. A pricing model built on fear doesn't distribute protection efficiently. It distributes it to wherever the fear happened to be standing when the salesman arrived. Run a labeled hypothetical and be clear that this is a hypothetical, not a proposal. Imagine the industry were required to quote alongside every premium the actuarial cost of the mortality risk being covered, the internal number, printed next to the retail one. Two figures on the same page, the spread between them visible at the point of sale. Nothing about the product would change. Only the information would. Ask yourself what would happen to the kitchen table question in a world where the buyer could see both numbers, and then ask yourself why no version of that disclosure has ever been standard. The distance between those two printed figures is the same gap Marcus found on his statement, multiplied across every policy in force, compounding quietly across decades of premium payments made by people paying for a feeling they no longer feel. So redefine the thing you walked in with. You came in holding a word: protection. Here is what the mechanism says that word actually purchased. Life insurance as a mathematical instrument is a transfer of tail risk, and that instrument is real, useful, and old. But life insurance as it is sold is something else. It is a transaction in which a temporary emotional state is exchanged for a permanent payment obligation at a markup determined by the intensity of the emotion rather than the size of the risk. What was insured on the day most policies are signed was not a life. It was an evening, a specific night of fear, priced at its peak and amortized over decades. That's the significance of the time dimension in all of this, and it's the part the sales process depends on your not noticing. Fear is an event. Premiums are a structure. The fear that closes the sale lasts weeks. The payments it authorizes last 30 years or more. And the lapse curves show, with actuarial clarity, what happens when those two timelines separate. The industry's internal math has always known the difference between a moment and a lifetime. The buyer's math is not supposed to. Which points to the deeper principle this episode is really about. Any contract signed in one emotional state and paid for in another deserves to be understood in the second state, the ordinary one, the Tuesday evening one. Because that's a state you will actually live inside for the length of the obligation. The moment of purchase is the least representative moment of the entire contract. It is also, not coincidentally, the only moment the sales process is built around. Notice also what this reframe does not say. It does not say the underlying risk is fake. Income loss is real. Mortality is real. Households genuinely do collapse financially when an earner dies as uncovered, and the 100 million people in the need gap are carrying real exposure. The mechanism doesn't work by inventing a risk. It works by hijacking a real one, by taking a legitimate statistical question, what is the probability-weighted cost of this household losing this income, and swapping it at the decisive moment for an emotional question that has no ceiling. How much do you love them? The first question has an answer measured in dollars per thousand of coverage. The second question has an answer measured in whatever you'll pay to stop feeling it. Every dollar between those two answers was never protection. It was the price of the feeling, collected monthly for decades by a system that priced your fear before you felt, and has been quietly counting on you never checking the receipt. They didn't build the system to trap you. They built it to keep you comfortable enough to stay. Here's the question worth sitting with this week. When was the last time you made a financial decision because of what you were afraid to feel rather than what you actually expected to happen? Fear monetization is one of the most profitable mechanisms in insurance, and the gap between what you pay for and what you actually need is where the industry lives. But underneath it sits a harder question. If a policy was never really the protection, what is? What does it look like to be positioned so that a mistake, even a serious one, doesn't end you? There's a form of wealth built entirely around that question, and almost no one measures it. That's the next episode.